Hey everyone, I've got a special guest with me today. His name's John Zanini. He's with Universal Mortgage, and he's been a mortgage lender since 2006.
Yeah,
roughly. He's a rock star at what he does. John's done a ton of different mortgages for myself, refinances. You've helped me with our rental properties over the years, over the last 15 years or so. We've known each other. Yeah, so I'm super excited to have him here today. He's got a brand new program. It's called an all-in-one loan that I wanted to bring him in to share with you because I feel like it's really important to know all your options. And John's one of those guys that he knows mortgage lending inside and out, and he has lots of different options that you may not know about, and he can tailor it to your needs. And so I wanted to bring him in so we could share this with you and so you could be educated, see if this program would be a good one for you. He's also going to share a little bit about universal lending. But before we do, John, can you just tell us a little bit about yourself?
Yeah,
and,
absolutely.
Yeah.
Thank you,
your
Brian.
family.
Pleasure to be here.
Yeah, absolutely.
We go way back, so I know we worked
go way back.
When you first became a real estate agent, back in early 2000s, I think. And
Yep, 2007.
happy you're back
Yes,
in it.
thank you.
We're fortunate to be working with you. My background is from California originally. Graduated from Colorado State in 1995 with a degree in environmental geology.
It's
And
perfect setup for mortgage lending, right?
right. And kind of fooled around in that for a while and did some drilling. Operated a drill rig, and
Okay.
that lifestyle was a lot about testing and traveling and having consistency. And realized when I was young, it's probably not what I want to do if I want to start a family.
Right.
And so from there, I kind of moved on, made a lateral move into telecommunications,
Okay.
and worked in telecom for about 2 to 3 years in the early 2000s. And back then, telecom was really big. Y2K came out,
Yes.
and I was part of a big layoff.
Oh, okay.
And so my
That's right.
wife at the time and I were laid off. Thank God we had a severance package. This was early 2003. And so I was pretty much unemployed. At that point, decided to get into real estate and achieved my real estate license and was a real estate agent with a number of different firms. Last firm I was working for was Keller Williams, and I was with them until about 2008. In the meantime, back then it was kind of wild, wild west with lending.
Yes.
No rules, regulations,
Right.
and so I started doing my own loans and kind of fell on this
We
side.
experienced
this
that
side
our
of it.
very first mortgage lender.
Yeah.
It was very Wild West.
It
And
was.
a bad loan, our very first one.
Right.
So, yep.
Right. So my story, compliance came down and we got certified and
Right.
fingerprinted and background, and I kind of fell on this side of it and realized most of my leads were coming from real estate agents.
Gotcha.
And I didn't want to have a competition there, so I just let my license go.
Okay.
And so I've been doing the loans. since.
Gotcha. So that's something unique to you. I mean, most people don't have, or mortgage lenders haven't been on the real estate side. So you've got a really
Yeah.
neat perspective from that piece that you bring into it, right?
I understand your stresses.
That's a big part of it.
For sure, yeah.
Yeah,
Yeah.
absolutely. That's awesome.
Yeah.
Great. Well, so what is it about mortgage lending now, today, where we're at, that you really find that's important for people to know and understand?
Great question.
Yeah.
There's so much information out there and the consumer has to kind of go through all that and process all that. One of the reasons why I'm with Universal Lending, and I've been here since 2018 now, is because our motto is people helping people achieve their dreams. And I think anytime you work with a company, the people behind the scenes that do all the work, the processing, the underwriting, the closers are all professionals. And it's really a team effort to provide the information to consumers and really allow them to make what is the proper choice for them and their family. So we are a wholesale mortgage bank. Our niche products, what we focus on primarily would be the Fannie Mae, Freddie Mac conventional loan programs, and then all the government programs as well. So FHA, VA, USDA loans, and we have no lender overlays at all. So if we run you through an automated system.
Now, for those who don't know what lender overlay is,
Yes.
Can you explain that? Not to
A
interrupt
lender
you, sorry
overlay
about
would
that.
be lender overlay would be, let's say FHA, for example, allows people to finance homes with a credit score of 580. We're going to honor that. Other lenders may say we're not going to do loans unless your credit score is above 620. That'd be an overlay.
Okay.
And there's a number of them throughout the process, but we underwrite our loans per guidelines, and we meet that criteria, we will honor it.
That's awesome. And that's really important because I think a lot of, like, I didn't even know about lender overlays till you told me actually about it probably a few years ago. And we've done multiple mortgages. You know, I think it's one of those things that I don't know if it necessarily doesn't get talked about, but it's just not really brought it forth. And I think it is an important thing for people to know about that is part of the loan process. You know, it's not everything, but it is a piece of it that's important to understand as you're getting a loan.
And it can be, depending on which state the bank you're using is from. I won't mention any names, but if you have a large bank from Detroit or those areas and they're not local, you might have seasonal problems that come up and getting through that. You know, sprinkler systems installed, or maybe you need a roof repair during the winter and you can't do a roof repair in the winter, so how are you going to deal with those type of things? Escrow repairs as well. If an appraisal issue comes up, and how do you deal with an appraisal issue and a repair? So those type of things are dependent on location. And so we are locally owned and operated since 1981 at Universal.
Gotcha, that's perfect. Awesome.
Yeah.
All right, well, thanks for sharing a little bit about that. So I really want to get into all-in-one loans. So this is a brand new loan program. My brother-in-law actually got one, and I thought he was crazy at first because I was like, what are you getting yourself into? The more I've learned about it, and John's explained to it, a lot of it about it to me as well, the more it's a really good option for some people. Now, some people, it's maybe not the best fit, but again, it's just one of those other options that is worth at least taking a look into to see if it's something that you want to do. So I'm going to hand it to you to just kind of go overall, kind of what is an all-in-one loan, and then we're just going to
I'll do my
dig
best.
into it.
It's a lot.
There's a lot there for sure.
There is. It's, so the all-in-one loan, it's not a new product. It's actually been around since 2005 with CMG. And CMG is a pretty large wholesale lender out of the San Francisco area. When it came out, it's really well known around the world, the rest of the world. If you look,
like other countries,
yes, Europe,
like that.
England, Australia, New Zealand, Indonesia. So most other countries have a product like this, and it's considered an offset mortgage program for offset. But CMG brought.
Can you explain what offset would mean?
An offset mortgage program would be where you are offsetting the interest on your loan.
Gotcha.
And so and typically you do that with home equity line of credits. I get to that a little bit more.
Sure.
But this program came out as it's called an HOA loan, so Home Ownership Accelerator in 2005, and it's been rebranded now. But the key driving point with this type of loan program is it combines a first lien position, home equity line of credit, with a 30-year term. Therefore, once you secure it, you don't have to refinance for another 30 years. You have access to your home's equity. And it combines that with another important piece, banking piece, which is your checking account. And if you can imagine how much money is ran through your checking and savings account and is stored there, and what is that money doing? So with this program, you have the first lien position, and you have a checking account. It's called an offset checking account, or a sweep. And every night at midnight, your balance goes and pays down your principal on your mortgage. And at the same time, you have access to that money you pay down, so you can go ahead and use it to pay your normal expenses, your monthly bills, and things you use for. So it's combined into one, and so your idle dollars are being used, which saves money ultimately for you. We all know if the longer you hold a credit line, the more interest you're going to pay on it. This program has been amazing without changing your habits and your spending patterns. Just utilizing this checking account, many people have been able to pay off their homes in less than 10 years.
That's huge. And so you can pay off your loan early. You can access your equity, which you can't do in a normal, conventional FHA type of loan, right? And then you're reducing that interest over time. And now tell me a little bit more about the checking side of it. So I think people will probably. I know when I first heard about it, I was like, so do I have to get rid of all my other checking accounts? What do I have to do there? How does that work?
Great question. No, not at all. And in fact, most people keep their existing checking account and just drive what they want through this. Of course,
like
the more you put into
from
it,
one check into the other, kind of a thing.
Full service checking account. So debit cards, ATM cards, excuse me, online banking, everything you have now, you have with this checking account. Two banks that they have combined with is North Point Bank and also Bank of Indiana. Those would be who hold your checking services, and it's just like any other bank. The main thing I would like to bring up about it is we've been taught to sell amortized loan programs, which again, those are great loan programs.
Sure.
They give you a fixed payment, you know what your payment will be. The problem with those is not really the interest rate on those type of amortized loans. It's the way the interest is applied. And with this program is you only pay interest on the daily revolving amount. And that's what makes it so powerful.
Yes,
so it
right.
recasts daily. It recasts. So rather than you paying interest over a 30 or 40 year period on the loan amount you borrowed, you only pay interest on your principal balance. And that's added up monthly. So
yeah, that's huge. That's a big difference for sure.
Big.
So if you deposit a whole lot of money 1 month, it's going to only calculate interest on whatever that balance is.
And again, another
That
point,
day.
people are, of course, it's been a very strong real estate market. Maybe you have some assets and you want to apply towards your mortgage. The fear there is how you're going to get it back out once you apply it. This allows you to access your equity. If you put maybe $100 in, the next day you can pull it out whenever you like.
Totally.
And
And that's been a thing I've talked to a lot of people about, and they're like, I don't want to put more towards my mortgage because what if I need that money?
Exactly.
So this gives you that flexibility.
It sure does.
Which is huge.
Yeah.
Absolutely.
Yeah.
Okay.
Yeah. Very, very powerful tool.
Yeah.
You can use this program in primary residences, second homes, investment properties. A lot of real estate investors, once they secure this, they just start running their rental properties through the account, pay off their principal, using the rent proceeds to pay off their principal, and build more equity quicker.
I love that. So if you know me, and if anybody's ever talked to me, you know I have a big passion about real estate investing and not using it just for buying and selling your own home, which obviously is huge, but then how can you think from a bigger picture and learn about how to invest in other properties? So this is a huge tool that you can use instead of getting a normal mortgage on there. And then what we did when we bought, when we turned one of our primary residences into a rental property, we put a HELOC on it.
Right.
And had I known about this at the time, I would have done the all-in-one because that would have made a whole lot more sense because then I could pull out that equity and use that for another property.
And home equity line of credits are a very, very good tool because again, you only pay interest on the daily amount you borrow, which is different than an amortized loan program.
For sure.
And so this program wanted to incorporate a home equity line of credit. However, this is in first lien position, so you have all the tax write-offs as you normally would have. And typically with seconds, like home equity line of credits, you'll have a period where it will balloon on you. And typically those programs come with a 5 or 10 year interest only option. And then after that it's amortized for another term for the rest of the term.
Gotcha.
Sometimes those will balloon on you. The nice thing about this loan program, this all-in-one program, is anytime you make a deposit into your checking account that night, that's considered a payment. So as long as you have equity on your line, let's say you have a home equity line of credit secured for $500,000, your balance is $200,000. As long as you have equity there, you essentially never have to make a payment.
Gotcha. As long as you're constantly depositing into it, so your normal
you can't have a late payment.
Yeah.
If something happens, you lose your job, or something where you need to take some time off, family, you don't have to worry about defaulting on your mortgage. There's never been a default on this loan. They have a great track history on this loan, which is fantastic.
Yeah, absolutely.
Yeah.
So it's really kind of open to all kinds of life circumstances. If something bad happens, if something good happens, you can use it for all kinds of things.
Yeah.
So I think a lot of people might wonder too, and this is something I had a question on, is, the term could be 30 years, right? For this,
it's a draw period.
It's a draw period, 30 years.
Yes.
So how does that work? Can you explain a little bit about, you can't draw the entire amount of equity, right?
Correct.
Anytime up until that 30 amount, it changes over time.
Right.
Yeah.
At some point, the loan has to be paid off, and the CMG wants a long-term relationship with you. For the first 10 years, you can draw up to your full line of credit you secured.
Right.
After the first 10 years, for the next 240 payments, basically it's reduced by 240 payments over the next 20 years.
Gotcha.
And that ensures that the loan will be paid off at some point.
Right. Okay. Gotcha.
Yeah.
That's good, because I think that'd be another fear that some people might have is at the end, oh no, I borrowed it all and now I'm owed, I have to owe it. It actually helps you to make sure that you don't get in that kind of a situation. Whereas like a normal HELOC, right, you could be borrowing all of it up until the end, and then there's a payback
it can balloon on you and be very difficult to requalify.
For sure. Yeah. So awesome.
Yeah.
Now, can you talk a little bit more about paying it off early? How does that work in the sense compared to a normal conventional loan or FHA loans and this? How many years did you say you could pay it off in?
Well, it depends. It gives you the power to be. Typically, people when they start utilizing this, they'll see the power of it, so they'll start driving more cash dollars into this account
Gotcha.
to offset the interest they pay.
Okay.
If you think about it, how much money are you really making in your checking account,
Right.
or your savings account? Not much. So this basically takes the interest that the banks would be making, and you are applying it towards your mortgage. So that's your savings there.
Yeah.
Also allowing
Gotcha.
you the flexibility to draw it out whenever you like. So
Right. Okay.
if that helps. Yeah.
Yeah, absolutely.
No prepayment penalties at all. Nothing like that.
Okay.
It's not for everyone.
Sure.
Obviously, you have to have some equity in your home. We can lend up to 90% of your home's value, but typically most borrowers will have at least 20% equity.
Okay.
The program also requires you to have reserves of your total credit line. So let's assume you secure a home equity line of credit for $300,000. They're going to require at least 10% in reserves.
Gotcha.
To make sure that you have that. So
Okay.
700 credit score minimum.
Okay, I was going to ask you about that, kind of some of the other qualifying things there.
Yeah.
Gotcha.
It is a manual underwrite, so it's not sent to Fannie Mae and Freddie Mac, but it does follow conventional guidelines.
Gotcha. Okay. Now, can you use this? Actually, let me back up a little bit. Let's talk about the interest rate. How does that work? Interest rates are all the rage right now, right? Because interest rates went up, they were super low, now they're high, now they're kind of evening out a little bit. How would that compare? Let's talk about a couple of different scenarios. If somebody, let's say, when rates were really low, they refinanced. Is this even would be a good option for them? I know it's always dependent on their situation, but maybe we talk about that scenario. Let's talk about interest rates where they are now and how it compares.
Great question.
Yes.
A lot of questions. So this is a home equity line of credit. And so anytime you secure a home equity line of credit, typically that's a totally different type of structure, how rates are applied. With the home equity line of credit, you usually have a prime rate. Today, the federal fund rate's 4, plus 3, they're prime 7.
Okay.
And then you have a margin with the home equity line of credit. And a good rate might be prime plus 1, 1.5. So home equity line of credit.
Stop you real quick. Can you explain prime real quick too, just so we make sure everyone.
The prime rate is
on the same
basically
page.
the rate that banks lend to each other.
Okay.
Perfect.
Perfect.
So there's a federal fund rate and there's a prime rate. And basically when you get a home equity line of credit, prime is what they use. And then there's a margin, typically at home equity line of credits.
Gotcha.
And so a good rate for a home equity line of credit would be 8.5 right now. Similar, this is how this program works as well. It's not tied to the prime rate. It's tied to the 1-year constant maturity treasury rate, which is like the 1-year bond. And there's they average it over a year, and every month it comes out, and that would be the rate they use.
So it's based off the last 12 months.
And they
rolling
average
12
it.
months.
Okay. For example, today
Gotcha.
in December, we just got a new one out, and it's 4.78% is the index. So that's what that 1 month CMT rate is this month.
Gotcha.
And then there's a margin on top of that, and you can go ahead and tie in your margin for the life of the loan.
Okay.
Starting at 2.5 all the way up to 3.75%. So consumers have different options on what margin they want. Obviously, how lower margin is going to cost more money.
Sure.
A higher margin, and then you have lower closing costs.
Right. Okay. That makes sense. Awesome. So if I just refinance and I've got a 2.8 whatever interest rate or 3% interest rate from earlier this year, would something like this make sense for me?
Yeah. And that's a great question.
Yeah.
Because many people have very, very low interest rates.
Right.
I secured 2.5% on a 30-year fixed.
Yep.
And again, the rate's not the problem on an amortized loan. It's the way the interest is applied.
Totally. Yeah.
And so,
That
typically
makes
you'll
sense.
pay more than half of that interest in the first 10 years.
Right.
With this program, the power is every day it recasts. And so, why would you want to pay interest when you're paying down your balance on your loan? Well, you don't owe that interest anymore.
Right.
So the rate's not the most important thing with this loan program.
Yeah.
It's the way how your payments
I
apply.
think that's a huge thing. It's just a mind shift, right? Because we're always so focused. And on any loan, really, rates is a factor. It's not everything. It's a piece of it, and especially in this loan, it's a piece that may not have as big of an impact, right, as the conventional loan or some other loan like that.
It's the way it's amortized, the rates are great. But again, how is your interest being applied? This is the only loan program that we know where interest is applied first.
Gotcha.
I'm sorry, principals
applied first.
Not interest. Right.
Gotcha. Okay.
Right.
That makes sense.
And then interest is calculated.
Okay. Cool. I think that's good. And it's a big difference, like I said, it's a mind shift around.
Mm-hmm.
This is why when when I first learned about it, I'm like, what is, does this even make sense? Is this some sort of scam or something like that? It's really not. It's just a different way of thinking about it. It's completely legit.
Amazing program.
Yeah.
And you're going to start hearing about it pretty quickly,
For sure.
And we want to share it with everyone.
Absolutely.
You have to go through a course and be certified to lend, and universal lending I think in July is when we are offered this, and we have a relationship with CMG. So we're pretty excited about having this option for our consumers moving forward. And
100%.
Yeah.
Let me ask you one more question for those who are thinking about investing, and then they do think about buying a rental property eventually. Can you use this towards a rental property?
Yes.
An investment property, and can you talk a little bit about that and maybe some of the differences between your primary and a rental?
So yes, you can use this for an investment property. Minimum down payment on investment property is 20% down. And basically you go through the same process as normal underwriting.
Okay.
Reserves again on investment properties, they're looking for at least 10% reserves, maybe 15, depending on your loan to value. So the way it works is the debt to income ratios follow typically conventional loans.
Right.
Your debt to income ratio, which would be all your liabilities and your new mortgage payment divided by your gross income, they want to keep that below 43%.
Gotcha. Makes
Now,
sense.
with government loans, you can push that a little bit higher, especially if you have private mortgage insurance added on, so a little more security. This one, they're pretty strict. They want to be below 43%. Beside that, it's common sense underwriting. We can also use asset depletion. So if you have someone who's retired and maybe they have assets in a retirement account, we can take that, whatever that might be, as long as it's liquidatable.
Gotcha.
Okay. And divide that by 120 and use that as income.
Yeah.
So you don't have to have a large monthly paycheck to qualify
Right.
if you have assets. So they use some really nice, cool tools.
That's awesome.
It's great. Yeah.
Yeah, absolutely.
Yeah.
Very cool. Great. So I think that's anything else about the all-in-one loan that people need to know about that would be helpful.
The way the interest is calculated, I would like to say, basically what happens is your daily, whatever your balance is on your mortgage, let's say it's $200,000 and your rate is 7%, they basically times that by 7%, divide by 365, and that daily amount is just added up for the whole entire month. The next month, the following month on the 21st, whatever that amount is just added to your line.
I see.
So a payment's never required, it's just simply, it's fluid.
Okay.
Just added.
Gotcha.
Yeah.
That's awesome. Great. Yeah, very cool loan program. Definitely worth checking out. Like John said, sometimes it's not always the best option, but it could be a really good option for a lot of you that are out there. It's worth at least asking and looking into it to see if it's worthwhile for you, if you could take advantage of it. And like you said, most lenders don't offer this, right?
There's only one lender, CMG.
It's just CMG.
Yeah,
and then
we have a relationship with them. So
so that's huge.
Proprietary, it is.
Yeah, so if you are interested in it, John's great contact. I'm going to put all the contact information in the bottom in our description or on the screen or somewhere, in the video, so you can get a hold of him. He's got some really good information about it that he can send to you in an email.
Yeah. If you'd like more, typically there's an interactive comparative comparison
that's right. You've got that on there too.
So if we have a mortgage statement from a customer, we can go ahead and if you go to my website, if you go there, you'll see it there. Plug in. I can help you with it, or just fool around with it yourself. But you compare your existing mortgage and then plug in the all-in-one and figure out what your savings would be. Perfect. So it's a very great tool that we want to share with
That's
everyone.
huge.
Too.
Yeah, absolutely. Awesome.
Yeah.
All right. Well, John, thanks so much for coming, sharing more about this.
Yeah.
Really appreciate you. All you've done for me and my family. And all of our mortgages across the many years. One thing about John that's really is huge is John actually truly cares about people, and I've seen it not only in our own life and when you've taken care of us and our loans, but many clients have said the same thing about you. You're the real deal.
Thank you. I appreciate that.
Yeah, and we just thankful for you, grateful for all you do for the mortgage industry and looking out for people and really helping them to achieve their goals and their dreams. So it's awesome.
Well, appreciate that. Thank you, Brian.
Absolutely. All right. So John, what other programs do you have?
Well, we have a number of programs to help consumers. And so typically when we start working with someone, the main thing is going to get an understanding of what they're looking for.
Gotcha.
What is your down payment you're looking for? What can you afford? Do you have a gift? Will this be your primary residence or investment property? But the first place to start typically is with credit. And I think it's important when you're trying to qualify for a home loan, understanding your credit.
Sure.
What's causing problems, if any. We can do supplements, all that, everything.
So you can really take people through, say, hey, here you need to pay these things off. You need to, do this, whatever, and give them a really good, clear plan.
Right.
Very specific steps, right, of what to do. That's going to help bump their credit up.
If you allow us to pull your credit and we get some income information, so pay stubs, maybe assets, verify what your assets are. At that point, you have a pre-approval, which is our first level of qualification. And with the pre-approval, we can write a letter for you. You can go out and look at homes. That would be the initial step. If you wanted a more thorough underwrite, we have a program where you can actually have a $5,000 earnest money guarantee. If we were to go through your initial approval, submit your documentation and underwriting, and we come back with an underwriting approval, and then we will honor $5,000 earnest money guarantee, and that's our strongest approval, which we highly recommend.
And that means if you can't close their loan for some reason, then you would give them $5,000, a refund $5,000 of their earnest money.
Yeah.
Gotcha. That's huge. That's something that is a nice to have. Now, is there a reason why someone wouldn't want to go through that approval?
No.
Right.
And more importantly, when a buyer goes through that process, they're comfortable with the process. They understand their credit, they understand their payment, they provide us documentation. So now they have confidence in the home buying process, which ultimately will save you money because you're a confident buyer.
That's right.
And we want to provide leverage.
100%.
We want to provide leverage to buyers in the market that's very competitive.
Very, very much so. And what I love about that too is a couple things. Like you said, it gives them confidence. So we're going to go look at homes, when you're done going through that full, kind of a pre-underwrite process, or TBD underwrite, I've heard it be called as well. Then that takes the pressure off. We're going out, we're looking at homes. It's not like, oh, I like this home, but I'm not sure if we're going to get it or not. There's already enough stress in this whole process, right? Like there's no reason to add more. So when you do that do all that hard work up front, then it's we just go look at homes, and we can have more fun at that point and focus on the things about the house during inspection and things that really matter without having to worry about the loan side of things. Yeah. It takes a lot of the pressure off. Two, makes your offer so much more stronger. That's a big piece of it.
And if maybe you're finding a house and you want to go after the house, be a little bit aggressive.
Yeah.
Yeah. Typically, most home borrowers don't realize that the listing agent will call me and have a conversation with me and find out where are you with the approval process, and we can come back and say we've submitted this. We have a $5,000 earnest money guarantee. We'll write a letter for the borrower and provide that to you,
100%.
which gives you separates your offer from others, and hopefully you can compete and win those bids.
100%. And I love that too, because I know I can even go to them. We're not trying to hide anything at that point.
No.
We can go to the other listing agent and be like, and I did this with our last clients. I said, hey, I think I had them call you or you call them. I don't remember what, but I said, please talk to them. Let them know, and I think she gave you a call, the other agent, and you had a good conversation. It was just easy. There's nothing there to hide. There's nothing there to try to dance around. And it gives them confidence so that they feel good about you as the buyer, that the loan's not even going to be an issue. So we can take that off the table at that point.
Yeah, buying a home should be an enjoyable experience.
Totally.
And everyone should be working together.
Right.
So we're always open. We'll talk to anyone. A listing agent calls in. We won't talk, of course, to a seller.
Sure.
But a professional that calls in, we will update them, keep them updated. We have a system that updates you as we move through the process.
Totally.
Again, Universal has a fantastic system to keep people updated and confident.
Yeah, absolutely. So I definitely always recommend that. Get as approved as you can possibly get, ahead of time, and it's good for them too, because then you really know in the end it's good for you, it's good for the transaction, it's good for the consumer ultimately, because then they really know, am I gonna what realistically can I get? Am I gonna get my hopes and dreams up, and then get disappointed? Right. It just takes all that off the table.
It does. It does. And again, it's the process. Many lenders can run you through an automated approval.
Sure.
Like Fannie Mae, Freddie Mac, VX. They have their automated system. This goes a step further. We actually submit your loan into underwriting. Yeah. As if you're in the
real
to be determined property, real eyes on it, and find out any problems up front.
For sure. Yeah. That's huge. Well, then you have time to take care of that, and then when that property comes up, because this happens all the time, right? Where we're all searching. The fun part of real estate is searching and looking at homes. Yeah. we don't. The loan, unfortunately, no offense,
That's
it's not that fun to go through a loan
it's scary.
process. Yeah, it's a lot of documents. It takes a lot of time. But getting that so that way you're set up well, so that we've had so many times when people have either not gone through a full pre-approval, and then they find that home, and then they realize, oh, I have things that are going to prevent me from getting that home.
Yeah.
Or we try to rush, and then we can't get the approval in time, and then the sellers accept a different offer at that point.
Yep.
It's just so much better to be prepared.
And our number one complaint with real estate agents is that, hey, the agents aren't confident. You didn't take them through the process, and now things fall apart. And the last thing we want to do is have consumers pay for a property inspection and appraisal and lose their money.
Totally.
So we don't want that at all.
Yep.
We will not be in business. We will not be in business long if that happens.
No, exactly. Yeah, let's get it all on the table, figure it out first. And what I like about that too is then you can also tell them, okay, here's your real price to look at. What's really reasonable. That helps me obviously as we're searching for homes, but then helps them to know, okay, going forward, here's what my payment's going to really look like, and then you can give them some scenarios too, right? If your taxes are around this area or around this range, or this is what that payment would look like. Then you're just good to go at that point, and you have that, like you said, the confidence is so important going forward.
And most sellers will take a lower offer in some cases if they know the borrower is well qualified.
Yes,
because
totally.
taking their home off the market is going to allow some time. They can't market it if they go under contract, so they might lose their position. They might have other plans on there. Maybe they're trying to buy another home. So having that confidence will help the borrower have leverage.
Totally, 100%. I saw that recently with some clients that we were working with too. I was able to negotiate under asking by quite a bit amount, just because of all the work you'd done with them up front. It was huge.
Well, thank you.
Yeah.
Yes.
So, awesome. All right, Joe. Let's talk about new builds and getting a loan for a new build. It's an appealing option for a lot of people, right? Get a brand new home. Now, I've built 2 new homes with different builders, and you go in and you love the beautiful models because they're all decked out, right? You have all this stuff in there, and I go talk to the sales agent and say, "Yep, we want to get a home," and they say, "Well, you got to use our lender, because if you use our lender, you're going to get these different incentives. Maybe you get a free basement finish, or maybe you get, closing costs. We'll cover some of your closing costs and seller concessions or things like that." And it's really appealing, and so most people do end up going with the mortgage or with the builder's lender, because it feels like that's the only way to save money and to get the best bang for your buck at that point, right? So you have a new program for new home buyers. Can you tell us a little bit about that and why this might be a good option for some people?
Sure. And again, great questions. New build homes are great homes, great option.
Yeah.
You walk in, long term. You don't have maintenance you have to deal with. Hazard insurance can be much cheaper because you have everything brand new. The thing about new builds is that they don't have to use the Colorado approved purchase agreement put out by DORA, and they have their own agreement. So the borrowers are subject to the contract that the builder is presenting, and you have to sign.
Yes, which, by the way, the builder's contracts are very much are their benefit. Right?
They definitely are.
Yeah.
So they're exempt from a lot of the real estate rules and regulations that existing homes are not. So typically, if you go to a new build, you'll put down some earnest money, and that earnest money will go hard very, very quickly. Your home may not be built for 9 months or a year, but your $10,000 earnest money goes hard, and you have to be approved, and so they try to go ahead and steer you. And I'll use the term steering, cautiously.
Yeah.
But really, that's how it feels. Use our lender.
Right.
But the fact is, if you go through,
because you still have the option, right?
Well,
they're not saying you must use our lender by any means. They can't do that legally, but they make it feel like that's the only, and sometimes the best or the only option. Yeah.
And in fact, the truth is, if you follow their contract and you go through the process with them, typically about 60 days prior to closing, you're going to have a certificate of occupancy that's going to be provided, which tells you you're pretty close to have your home finished.
Right.
At that point is when you want to shop.
Yep.
And what we do is we're going to give you our best pricing and say, look, Mr. Lender, here's our best pricing. and here, provide us yours.
Right.
And the borrower deserves the best pricing.
Yeah.
And if we can go ahead and compete, many times those builders will allow you to go ahead and use a lender of your choice because they want to sell the home to you.
For sure.
Yeah.
Yep.
And in the builder's defense, when you're building a home from scratch, there's a lot of money that goes into that.
It's a lot of
timing.
Yep.
So again, that's why they're exempt from some of these things because they want to
Sure.
make sure that the people are buying are well approved,
That's
and
right.
so they put you through that process. Many times the incentives they're offering is basically what they're doing. They're just increasing your interest rate, and there's a yield spread on the back that they're giving back to you. For example, on a $500,000 loan, typically in a normal environment, it's just the last 6 months has been kind of crazy with rates going up. But typically, on the $500,000 home, for example, if you were to take an eighth higher in rate, you might get $1,000 to $1,500 in a credit. And that's many times what the builders are doing.
Gotcha.
They're just increasing the rate, providing
Right.
a higher rate, and that's your money anyway.
Sure.
Now,
It's not really,
yeah.
In addition to, they're just pulling it from somewhere else.
Right.
At that point.
Now, universal lending, we understand teaming up with new builds is very important.
Yeah.
And we want to team up with them.
Now, what, I know a lot of, like, when I talk to builders and some of the salespeople, they'll be like, well, the problem with going with other lenders outside of our own is, we can't, they don't communicate. We don't, they may not get it done in time, all the things, all those kind of stuff, which can happen, right? It's true. They say that because it's happened, but what, can you talk to that a little bit about how you make sure that, you have it right here on your document, close on time.
We don't have any lender overlays. So many times we will get the loans that the builders can't do.
Yeah.
Also, many loan officers who are struggling for business will go run to new builds, and because they can work for new builds and not have all the compliance. In fact, real estate agents, the sales agent does not have to be a real estate agent to sell.
So they don't need their license.
They
That's
don't need
the
their
important thing
license.
that I think a lot of people think is all salespeople at new builds have to be licensed, and they don't.
They don't.
Yeah.
Only one person has to be licensed.
Right.
So again,
they all work under that.
I mean, there's you have to be careful.
Yeah.
Trend lightly, be cautious, but also at the end of the day, if you go through the real estate contract, the new build contract, and you get anywhere to 45, 60 days out, you'll get that certificate of eligibility or occupancy.
Yep.
Certificate of occupancy. That is when you want to start shopping,
Right.
do your due diligence. And again,
Sure.
if I can provide you with the fees worksheet and they can match and give you the incentive, then every single time I'll say, please use them.
For sure, yeah. John's not gonna be try to convince you otherwise. That what he's just to get the business.
Yeah.
Yeah, it's more about let's just look at the options. And I think most people, again, just not without realizing, think, well, this is my only option. And in real estate, there's always many options. And it's worth at least looking into. Educate yourself, talk to John, especially if you're interested in new build. And then also the other thing I think a lot of people think on the real estate side is they don't need an agent because it's a new build, and there's a lot of value that agents can bring to be representative, and it doesn't cost you anything to use an agent to buy a home. So it's important, having your agent go to, I'll go to all the different building meetings along the way. There's pre-build, there's, pre-drywall, all these different meetings they have. You have the right to inspect along the ways,
absolutely.
which is something I think a lot of people don't realize is you can bring in your own inspector.
Yeah.
Really at any time. You've got to coordinate with them, of course, but they're open to that. And having an agent on your side, having a lender on your side, making sure the builders, because they are really working for themselves and the contract is really put together for them, to have a couple people on your side that are working for you, they're looking out for your best interest, and care. And then at the end of the day, if they're, like you said, if their loan program is better, then go with that. That makes sense. But at least look into it, right? There's no sense of leaving an option on the table and then later going, oh, I didn't know. I wish I would have at least looked into it.
You don't want to take a higher rate than you have to.
Right,
and
exactly.
That's what happens.
Yeah.
There's a little trick there.
For sure.
Your incentive, really, you're financing your own incentive.
That's right. Yep, 100%. Awesome. So give John a call on if you're looking at buying a new home. Let him know the timing, and then he'll kind of get your information and make sure that you at least know the options around it. So awesome.
Sounds great.
Cool. Okay, John. So rates have gotten high, right? It's a thing where people are looking for a lot of different options now, right? Like how can I buy down my rate? How can I do all kinds of things here? Can I I'm just trying to even think.
Two one buy downs are big right now.
2-1 buy downs are
Yeah.
huge.
Yeah.
How can you be creative right now with high interest rates? So we were just talking a little bit ago about assumability, and that's something I think a lot of people don't. And I'll be honest, like even for me, I've always thought it's just not even like you can't assume a loan anymore. Like that's not even a possibility. So can you talk a little bit about are there some ways to do that now? If somebody did get that lower rate, maybe see if that's an option.
Yes, and so that's a big topic right now is assumability and the 2-1 buy downs. Assumability, FHA loans are assumable to most people. So if you have a rate, let's say in the low 2s or 3% right now, it's a very attractive rate. Rates currently are low to mid 6s. The seller can actually allow you to assume their loan if you can go ahead and cover the difference in the principal. So let's assume I owned a home for 10 years. I have a 2.5% interest rate. I started out, my loan was $500,000. Now I owe $250,000, and you're buying the home for $750,000. If you want to assume the remainder of my loan, which is $250,000, you go ahead and apply for that. You'd have to work with the servicer of the loan. And you'd have to go ahead and agree to the terms. So they would qualify you and send through that qualification process, make sure you're employed, you can make the payment, but you actually can assume that loan.
Gotcha.
Which could be a big benefit for sellers.
Right.
If someone's looking for a low rate in this environment.
Yeah, absolutely. Now, do you have to go through let's talk about the buyer side. You have to go through, it's an underwriting process from the current service provider.
That's correct.
Okay.
Yes.
Gotcha. So then do you get involved in that at all? Do you help any of that process, or is it really just working directly with them?
Great question.
Yeah.
And typically what happens is a listing agent will talk to the seller about it, and they'll reach out to the servicer and let them know that we want to market this home with this assumability. We have a contract, and then you'd get the servicer involved and go through that process.
Okay.
Yes. The main thing about that is if you're a seller, you want to make sure that you remove your liability. And so there's a special form that the title company will complete.
Okay.
And removing your liability from your home is the most important thing. You don't want to be liable if they have a default later.
Right.
And of course, that also is very important if you have a VA loan, because VA loans are also assumable.
Yeah.
Which is very important.
For sure. What about the process timing to do that? Does it take a while to go through, like when you're, like let's say you're a seller, right? Do you want to go to that service provider early on? Is that something you can do later? Do you know about how long that takes? And then once there's a buyer who maybe wants to assume it, can you talk about that timeline too?
As a real estate agent, if you are listing a home and an offer comes in and someone in the offer says, we want the ability to assume your mortgage, you might want to have a little more time to do some research and talk to the servicer. But you're going to have a certification authorization form signed by your borrower so you can communicate with the lender.
Gotcha.
So it may have your borrower reach out to the servicer, ask for the certification authorization, which will allow you to communicate directly to the bank, and at that point go through their process.
Go through the process, gotcha.
And these assumabilities, that's something we would never be involved in.
Okay.
Because we originate the loans. This is a loan that's already been originated, and it's been serviced, but it is a big topic, and people should know about it because rates are going up. So it's a great tool for sellers.
Right. Well, especially if somebody, they love their rate, but they got to get out of their house, right? And they go, we have to sell. Unfortunately, especially now, homes are taking longer to sell, right? So anything you can have on the sales side to help incentivize buyers to come in is huge. Yeah. Is there anything a buyer can do to know if they can assume a loan? You know what I mean? So if there's, can they kind of get themselves pre-qualified, or can you take them through some checks to say, you look like you could be a good candidate for assuming a loan? Great question again. If you're a first-time home buyer, for example, and you have very little money down, you probably don't have enough of a down payment saved up to make up the difference of your purchase price and what's owed. And that's a good point, because you got to bring all that cash between that. Assuming a loan doesn't mean you get to increase that principal balance at all. Right. And it's going to be very difficult to assume a loan than have a second lien position on a purchase to make up the difference. So it can be a little complicated. Sure. That makes sense. So working with your agents and finding out if that's an option would be something the consumer would want to find out quickly. So, and I think that's a good point we didn't necessarily touch on, and maybe it's obvious to some, but some maybe not, is that you have to bring that cash difference between the current loan that's already on there. Yeah.
Some way, somehow,
Yeah.
correct.
Just not assumable, and now we can change terms
Right.
at that point.
Right.
Yeah.
Yep. And also with VA loans, many people, I've heard, it's their understanding that only a VA loan can be assumable by a family member or another
I thought
veteran.
that for a while.
Yeah,
Yeah.
that's not true. It's not true.
Right.
VA loans are assumable. But again, you have to make sure you have a release of your eligibility.
But not just assumable by someone else in the military. They can be assumed by others who don't have that VA benefit. Is that right?
That's correct. That's
Okay.
correct. When you qualify for a VA loan, you have to go ahead and pull your certificate of eligibility, which will provide you with your entitlement. And if you have full entitlement, when you secure a VA loan, your entitlement's being used.
Entitlement meaning how much you can borrow or how much of a loan you can have.
Correct. VA, if you qualify for entitlement, if you're a veteran, you can borrow up to, on your first home purchase, there's no loan limit. But VA will insure typically up to the conventional loan limit, which actually in 2023,
go up.
yeah.
Yeah.
I think it's, I want to say it's, what is it, 726, 200, something like that.
Yeah.
It just came out the other day. But so therefore, if someone assumes your mortgage, they're assuming some of your entitlement. Now, if your loan balance is $200,000, you might have additional entitlement you can use.
Sure.
But again, as a veteran, you want to transfer that entitlement to another veteran,
Yep.
or make sure that your lender will release you from that obligation
Gotcha.
and release your entitlement in full. So there's ways to do
Right.
it.
Yeah, absolutely. That's a huge thing that I don't. It's interesting. I've talked to several people who've been in the military, retired, talking about their VA loan, and there's a lot more that you can do with it than I think a lot of people realize. And those who have that benefit, I was just talking to someone the other day about this, and I was like, yeah, you can assume another loan, a VA loan from somebody, or someone can assume it from you. You can use your VA loan, multiple times.
Yes. If
And I think that's just some
absolutely correct.
and I don't know where they come from, but there's some misconceptions out there that it's a one-time deal, and once you use it, you're done. And I think that's something that's really important for veterans, especially to, really understand fully their full benefit there. It's a great program.
It really is. And with home prices going up,
Yes.
when it first came out, your entitlement was good up to $144,000.
Interesting.
But now it's up to conventional loan limit, which is $726. So
Huge difference.
if you owe $150,000, for example, you still have potentially, up to $550, maybe $575 left to use,
Right.
and you can buy another primary residence.
Yeah, absolutely.
So you can turn one property into a rental property, go buy another primary.
That's exactly what I was going to ask you.
Yeah,
If you've
with very
got-
little down and great
Yeah.
rates.
So you can keep your VA loan on your current property, rent it out. Now it's an investment property, and use the remainder of your entitlement
Yes.
for your next primary.
Yes.
Now, can you use VA loan for an investment property?
No.
No. So that's the important distinction, I think.
Right.
Yeah.
If
so you
you're
have
going,
if it's a primary first.
correct.
Yep. And there's nothing there that they have to do to turn that into investment property, to be released of the VA, anything from the VA side.
Well, it depends if you want to use any income from your rent. If you're turning a primary residence into an investment property and buy another home, and you want to offset that mortgage payment, then you'd have to secure a lease agreement.
Sure. Yeah.
But they will allow that
Okay. Gotcha.
to offset. You
But they're
can't
not gonna
use
make
any additional
you-
income, but you can offset your liability on that home
Gotcha.
that you turn into a rental.
Okay, that makes
Yeah.
sense. Yeah, and there's no issue with, hey, I originally got the VA loan and now I have to take away that VA. I don't even know how to say exactly that entitlement.
Yes.
You know what I mean? I can keep that VA loan I originally got on the primary residence without having to do anything else. Like I can just leave it in place, basically.
Correct.
Okay.
So let's say you use $200,000 when you bought your primary residence.
Yeah.
And your 726,200 approximately is where the new conventional loan limit is. So you still have $526,000 that you can use before you're required to have a down payment.
Gotcha.
Now, if you want to go above that, then you will go ahead and have to put a little down payment.
Then
But
you bring the down payment there.
yeah, but there's a whole
Gotcha.
calculation for that. It's not too hard, but
Sure.
but you
That
can do
makes
that
sense.
too.
Awesome.
So great option for
Yeah.
veterans. Really good
Very,
option.
Very great option.
Yeah.
Yeah, absolutely.
Yeah.
Is there anything else on VA loans that are misconceptions or things that you can think of that
They're
people don't know?
other than the all-in-one loan.
Right.
The one thing about VA loans is that there's a funding fee. And if you're a first-time home owner and you first use it, it's 2.3%.
Yeah.
If you use it a second time, it goes up
Okay.
to 3.6. So that can be a large amount of money. For
Funding fee going
$100,000,
towards your closing costs.
what's that?
Funding fee going towards your closing costs.
It's a one-time fee that VA charges. There's
Okay.
no monthly private mortgage insurance with
Sure.
a VA loan. So you can
Right.
borrow up to 100% and not have any monthly private mortgage insurance. But the funding fee is their insurance.
Gotcha. Okay.
And so, on a $500,000 loan, 2.3% can be over $10,000. So that's the one thing about VA you need to be aware of.
yeah.
Many
So it's
times,
not like you're going to come to the closing table with no cash at all and buy the house.
unless you are exempt from the funding fee, if you are
Okay.
injured
Okay.
and you have disability,
It's like permanent
benefits.
disability. They may
Right.
waive that then.
they could. And one of
Okay.
the first things we do, if you are a veteran, we will go ahead and pull your certificate of eligibility for you up front. It doesn't take very long.
Sure.
And find out if you are exempt and make sure that you have eligibility.
Okay.
Yeah.
So that's interesting. I don't think I even knew that. So if somebody has full disability and they're exempt
Yeah.
from it,
Yeah.
they could literally go
That's
buy a
a
house
great
with
program.
nothing down. Like no money
Nothing
at the
down.
table. That's amazing.
And lowest rates in the industry.
Yeah. Gotcha. Okay, that's what I was going to say. On top of it, yeah, you're going to get lower rates.
Yeah, that program's not credit score based. So you
Okay.
don't have to have perfect credit. There are some negative adjustments if your score drops below like a 680 typically, but
Okay.
we're hoping that we're coming out of COVID and VA and FHA have really tightened up their guidelines when it comes to minimum credit scores.
Okay.
And so now we're starting to get investors that will work with people that have credit scores
Right.
below 600, which in the past was normal,
Okay.
but it tightened up quite a bit through COVID.
Gotcha. So that's starting to loosen a little bit. Hopefully that's going to get more people qualified to be able to get into the house.
Yeah, typically as rates increase, guidelines will ease,
Okay.
and that's
Yeah.
in general that's what we should
That makes
expect.
sense. Yeah.
That makes lenders will make more money, they'll take more risks.
Right. Okay. Cool. Awesome. Yeah. Great information. So if you're in that situation where you can get a VA loan, if you're at least looking at assumability,
Sure.
again, go see John. He knows these
Happy to
things
help you guys.
inside and out.
Yeah.
He's been doing this for a very long time, and can just show you all the options there and help you know what's best for your situation. Awesome.
Thank you.
Thank you, John.
All right.
You're awesome.
Okay.